Silver just gave investors one of the strangest signals in the entire commodities market. At the start of this year, silver ripped to $121 an ounce. And now Bank of America says the very deficit that helped fuel the rally could collapse by 90%. On the surface, that sounds bearish. It sounds like the silver story is over. But I think that misses the bigger shift happening underneath the market, because silver may be moving from an industrial pricing story into a monetary pricing story, and those are two completely different worlds. For years, the mainstream silver thesis was simple. Solar panels, electric vehicles, electronics, and the green energy transition were going to consume more silver than mines could supply. And for a while, that was true. Silver ran a deficit for close to half a decade, and solar demand alone consumed roughly 6,500 tons last year. But when prices explode, manufacturers do not just sit there and absorb the pain. They redesign, they substitute, they engineer silver out wherever they can. That is exactly what has been happening in solar. China installed 400 gigawatts of solar capacity in 2025, but guidance for this year is closer to 200 gigawatts. At the same time, older PRT solar cells, which used more silver, have been losing market share to newer TOPCon and heterojunction architectures that use less. So Bank of America's point is not that solar demand disappears. It is that solar may no longer be the force setting the price. And that raises the real question. If solar demand is cooling, what pushed silver all the way to $121? The answer is not panels. It is investor flows, physical shortages, and monetary stress. Bank of America's own fair value model based on industrial production and euro-dollar dynamics only justifies silver somewhere around $60 to $70 last year. The move above $100 requires something else entirely, and that something else is now showing up in three places. First, India. In October, India imported more than 50 million ounces of silver in a single month, while China's net silver exports were only 13.8 million ounces. India was absorbing far more silver than China was supplying, and domestic Indian prices traded well above London prices, which is exactly what you would expect during a localized physical shortage. Then India raised import duties on gold and silver to slow pressure on the rupee. Think about what that means. Silver is no longer just an industrial input. It has become large enough to matter for currency pressure. Once a government starts interfering with hard asset flows to protect its exchange rate, the metal has entered a completely different category. It becomes part of the capital flow story. It becomes political. Second, China. While India was pulling silver in, China had been a major exporter. But in the first quarter of 2026, Chinese silver imports picked up significantly. And when China steps into precious metals, the question is always the same. Is it industrial demand, strategic inventory, arbitrage, or monetary hedging? Usually it is some combination of all four. And that matters because Chinese demand cannot always be modeled like ordinary commodity demand. Some of it reflects intentions the market may not fully understand until much later. Third, tariff-driven liquidity fragility. Last year's silver squeeze was heavily shaped by fears that the Trump administration would impose tariffs on silver imports. Traders rushed metal into the United States before restrictions could hit. London liquidity tightened, lease rates spiked, and the market started to worry about whether silver could function smoothly under stress. Those tariffs were not implemented, and silver eventually flowed back to London, but the fragility did not disappear. With the USMCA joint review scheduled for July 1st, and Canada and Mexico being two of the biggest suppliers to the United States, the market may already be pricing in another squeeze. Silver pushed back above $80 in early May, and Bank of America called it a déjà vu of the 2025 squeeze. So the question investors need to ask is simple. Which silver model are you using? If you are pricing silver like an industrial metal, you ask how much silver a solar panel uses, how fast recycling grows, how much mine supply is coming online, and how quickly manufacturers can substitute. That framework gives silver a ceiling. But if you are pricing silver like a monetary metal, the questions change completely. What is happening to inflation? What are real yields doing? How credible are fiat currencies? Is the silver people think they own actually sitting in a vault? Or is it just a paper claim? What happens if too many people want physical delivery at once? That framework does not give you the same price range. It gives you a completely different market. Bank of America says physically backed silver ETF assets declined last year. Futures positioning is not stretched, and speculative appetite is still limited. But visible inventories in LBMA and CME warehouses remain well below recent highs. That means there is no obvious supply overhang. Investor demand has not even made a decisive move yet, and physical inventories are still tight. Bank of America believes a gold rally could push silver back above $100. But it does not expect silver to sustainably outperform because the industrial story is easing. I think that is probably right about the industrial side. But the bigger question is whether the monetary side is just getting started. The solar slowdown is real. The 90% deficit collapse may be real. But the Indian import surge is real too. China's accumulation is real. The July trade review is real. The lease rate spikes, London liquidity drain, and tariff-driven squeeze are real. Silver at $80 in a market driven by solar demand is one thing. Silver at $80 in a market where governments, investors, and physical shortages are becoming the marginal price setters is something very different. And that is what makes this moment so important. The industrial era of silver pricing may be fading, but what comes next could look much more like gold, driven by macro pressure, currency risk, geopolitical stress, and investor conviction. The 90% deficit collapse and the monetary repricing can both be true at the same time. In fact, one may be enabling the other. And that is why silver is worth watching now, not because of some random price target, but because the framework behind the price may be changing.